Yes, my followers, welcome once again uh, in our class that is financial reporting, accounting for partnership. I think now since we have described or we have discussed the characteristics, I think now we'll start directly to the accounting for retirement of a partner. Remember we said that in case there is a retirement, death, or dissolution of a partner, or anything arising in a firm, that is partnership firm, what happens is that the whole firm is dissolved. Now, I want us to look on the accounting for retirement of a partner. What happens when a partner retires in a partnership form of business? Remember, we have two approaches to this. One approach is about the how we value the goodwill, and the other aspect is about the revaluation of asset and liabilities. So from the examples that we'll be having right away is on goodwill. To the other classes, we'll be following on what will be happening on revaluation of asset and liabilities. But let's start with the first method, which involves goodwill. May I say that upon retirement of a partner, the whole partnership is dissolved and a new one is formed. This is, as I had said earlier, this is automatic to partnership. When anything new happens, maybe retirement or all those forms, we have to dissolve that old partnership. At a point of retirement, there could arise a goodwill, and that must be revalued. There could arise a goodwill that could be revalued. What is a goodwill? We say that goodwill is regarded as an asset for the partnership. In other words, may say that goodwill is like an intangible asset. We say that goodwill is like the reputation. You have been operating the business. What have been the reputation of that business is what we refer to as the goodwill, and it is valued. And we say that, as I've said, goodwill is a form of intangible asset. It is an asset for the partnership, though it is intangible. You can't see it like as you say or you value the features all over it. It is valued, but it is intangible. We say that partnership firms from which profit and loss must be shared by existing partners in their profit sharing ratio, the goodwill should be credited to the partner's capital account and debited to the goodwill or the asset account. What do I mean? We say that the goodwill should be credited to the partner's capital account. Remember, this is like a profit that they have realized. So it should be credited or be handed to their initial capital account, and it should be debited. Why should we debit the goodwill? It is because it is a type of an asset, and automatically when an asset increases or when asset increases, we debit them. So when we realize any form of goodwill, we debit to the goodwill account and we credit to the partner's capital account. Or in other words, we try to increase the partner's total amount that they have with their or in their capital account. However, this goodwill must be written off to the remaining partner's capital account in their new profit sharing ratio. Remember that we write it, or we should write it off to the remaining partner's capital account to show that it was used up or it was shared when the land or the retiring partner was yet active in the business. By so doing, the amount payable to the retiring partner is determined and it should be paid to them. Remember, as I've said, is like goodwill is like the reputation of a business. When you value the goodwill of maybe 20,000, that is the reputation of that business, and you should not exit without sharing some part of that good name that you've created to that form of business. and now it should be written off to the account of the remaining partners. As we'll be looking or following the example, I think we'll understand more. As I've said that we have the first method, that is the valuation of goodwill. Now you want to value the goodwill. How will we value this goodwill? Two entries take place when we value the goodwill. One is that there is an entry or entries upon valuation of goodwill. That is, we debit goodwill account with the amount that is maybe that is ungreened or that is valued. We debit the goodwill account, or we say that we have realized this amount through the business reputation. So because it is an increase, we debit the goodwill account. But that same amount, we credit the existing partners or the existing partners capital account with the same amount. Let's take an example. It was 60,000. We debit that 60,000, but we subdivide it among the existing capital account of the partners. That is like, you can't debit goodwill of 60,000 yet credit goodwill of 50,000. No, it is the whole amount. That is the first entry that is done. The second entry is the entries upon writing off the goodwill. Remember, we have said that we have to write this goodwill off. What do? We debit the remaining partners' capital account. The remaining partners, we debit their account because they have contributed to what maybe they have valued and given the land or the retiring partner. So we debit the account. Now, since we had debited the goodwill, we now credit it to mean that it have been used or it have been already used. Remember, when we fail to debit or to write off by crediting the goodwill, it means that the goodwill is still existing. I remember when we debit when we write off, we never include the existing or the retiring partner in writing off a goodwill. Let's look or we go through an example so that we can understand more. There is an example that A, B, and C are three partners sharing profit and loss in the ratio 5:4:3 respectively. Respectively means A is sharing 5 out of, I think this is 12, 5 out of 12. This is 5 plus 4 plus 3. So he is sharing 5 out of 12. B is sharing 4 out of 12, and 3 is sharing 3 out of 12. The capital account balances just before the retirement of C is as follows. He had a capital account of 80,000, B had a capital account of 70,000, and C had 60,000. We are still continuing. C retired and goodwill was valued at 60,000. By the time C was retiring, the goodwill was valued at 60,000. Note better, so that this will never be a big deal when we are doing the calculation. Thereafter, the remaining partners agreed to share profit and loss in the ratio 7:5 for A and B respectively. As I've said, respectively means A will now be receiving 7 out of 12, and B will be receiving 5 out of 12. Now the question, show the accounting entries upon a retirement of C and prepare the partner's capital account. We proceed. The solution. Here, two major concerns are looked upon. One is the entries upon valuation of goodwill. As I had said that goodwill is a special type, or it is an asset. So if we realize an asset, it is like an increase in an asset. What do? we debit that asset. Now we debit the goodwill account with the 60,000. Now the 60,000, we subdivide it by crediting to respective partners' capital account. You realize the A's capital account, you receive 5 out of 12 times 60,000, which translates to 25,000. B's capital account, B will receive 4 out of 12 times 60,000, which translates to 20,000. C's capital account, C will have a share of 3 out of 12 times 60,000, that is 15,000. When you had 25,000 plus 10,000 plus 60,000, as I said, this should total up to 60,000. This should total up to 60,000. That is the second entry that should be done. That is the entries upon the rating of the goodwill. Remember now, the goodwill is no longer in the business. So we should write it off. We should show that it was shared. How will we share? We show as an accountant, we never subtract, no. If we had debited a given account or we had a debit entry, to show the opposite, we credit that given entry. So I think as we had debited the goodwill, now we'll be crediting the goodwill with the 60,000. And now as we are crediting, we'll now be debiting the capital account of the remaining partners. That is the partners that are now starting a new form of partnership after retiring of their fellow partner. We realize that the ratio, it was agreed that it is 7:5. That means A was to share 7 out of 12 times 60. That is that 5,000, and B was to share 5 over 12 times 60, that is 25,000. And again, this amount should sum to 60,000. That is just an introductory part to our solution. I think you are following. Now, we were asked to prepare the capital account or the allocation of the capital or the allocation of what we have done to an account called the partner's capital account. We have it in this structure. We have the details. We have A, B, C. That is on the credit side. On the debit side, we have the details A, B, C. That is that. At the very starting, you realize that we had the balance brought forward, or the balance that we had before even the valuation of the goodwill. Remember, the A, and these balances, remember the capital balances. A had 80,000, B had 70,000, and C had 60,000. That is what they had before the valuation of the goodwill, or in the very first of the start of their partnership. Now, after the end, continuing with the operation, they valued a goodwill of 6,000. What did each partner receive? He received, that is the goodwill, he received 25, as we had seen here, as we had calculated. He received 25,000, B received 20,000, C received 15,000. Now we feel he received 25,000, B received 20,000, and C received 15,000. Now there is something new that came in. Now C retired. What happens if C is retiring? C is retiring and he or she is in need of an amount of 75,000. Just to note that. On the debit side, since now C is retiring, we write off the goodwill account. We write it off. We write off, as we had illustrated here, by using the new profit sharing ratio, exempting the exiting partner or the retiring partner. And we saw that A was to receive 7 out of 12 times 6,000, which is 25,000. B was to receive 25,000, that is 5 over 12 times 6,000. Those amount we should indicate, or they should eat the debit side of the capital account. And that is what we have illustrated. B received, B, the amount that should eat to the debit side of the goodwill written off in A is that 5,000 and B is 25,000. But now remember, we have an issue. B or C is in need of fees or 75,000. So this, we should reckon it as the amount payable to C. That is 75,000. Now from that point, since we have no any other information, we do what we call the balancing off. You see this for A is 80,000 plus 25,000, that is 105,000. So the account of A should balance at 105,000. Now, since these signed have more than this sign, this we have only that 5,000, and here is 105,000. What do we need to balance off? That is, we credit A's account. No, we carry down an amount of 70,000, which we should debit to A's account so as to total up to 105,000. And we also carry down an amount of 65,000 to B, so as the balance should balance at 90. Sorry, this should be 90,000. Yeah, it is 90,000 as it is written. 90,000. That is the balance that is recording B's account on both sides. And on C's, we have the recording balance as 75,000, both at debit side and credit side. And now these amount that I've indicated using the red color, this is the amount that is payable to C on retirement. Hope we've understood. Let's continue. We have another example, that is example 2. I would like it to follow this example also so that we can understand more. It reads, PQ and R are partners sharing profit and loss, or P&L, in the ratio 5:3:2, respectively. Not these ones, respectively. That means P received 5 out of 10. I think this is 5 plus 3, 8 plus 2, 10. So this means P received 5 of 10 out of 10, Q received 3 out of 10, and R received 2 out of 10. But we have been told that on 31st December 2020, the imbalances was as follows. This is what was obtained from their books. That is the imbalances. I want us to follow the imbalances. As you can see, we have this is, I think this is a balance sheet. We have plant and machinery, amount is 43,000. We have furniture, 16,400. Inventories, 35,100. And the debtors, that is 23,500. When you look onto the credit side, you realize the creditors, 15,600, bank overdraft of 2,400, capital account, P hand 50,000, Q hand that 1,000, D hand 20,000. We proceed. Now we have an additional information. This is very important to check on because they just give you the starting point or how you should tackle your question. You have been told that Q retired. When we talk of Q, remember that they were 3 partners, P, Q, and R. Now the partner by the name Q retired on 1st January 2020. Remember, the partnership commenced on 31st December 2020, but now Q retired on 1st January 2021, and the following was agreed. 1. That Goodwill to be valued at 25,000 and Q was to share. Why Q was to share? It is because he was active where the business was in operation and the business valued Goodwill at 25,000. Roman 2, P and R. What do we mean? The remaining partners, that is P and R, to introduce fresh capital so as to ensure that the new capital, total capital amount to 100,000. Remember what have happened? When Q is withdrawing, the amount of capital will decrease. Now they have agreed so as to maintain the running of the business as earlier, will introduce new capital so as the total capital should total to 100,000 and their new capital account are in their P&L sharing ratio, and their new capital account are in their profit and sharing ratio. Now, that was the question, but what should we do? That is, what are we required to do? We are required to show the journal entries for the transactions and extract the partner's capital account upon retirement of Q. We show the journal entries, then we extract the partner's capital account upon retirement of Q. Let's see how we should deal with it. This is the solution. I said that immediately there is a change in maybe retiring of a partner, two crucial things happens. We have the entries upon valuation of goodwill and the entries upon writing off the goodwill. And I know, as you can remember, we said automatically we have to debit the goodwill. That is what have been acquired. That is the business reputation. That is a special type of asset that have been realized. That is that we debit the goodwill of 25,000. This goodwill should eat. It should eat the debit, the debit, or it should be debited. We'll see how it will happen during the recording of those transactions. And another thing that we should do is we should credit the existing partner's account. Remember, when we say or we mean existing, we include even the retiring partner when we value the goodwill. That is P's capital account. That is 5/10 times 25,000. So P will share an amount of 12,500 on goodwill. Q will share 3/10 times 25,000, which is 7,500. And R will share 2/10 times 25,000, which is 500. That is the first entry upon the retirement. The second entry is upon the writing of the goodwill. What do? We credit goodwill account because we want to write it off in a layman language. Since we had debited, debiting is like meaning that we have something with us. Crediting is like meaning we have distributed what we had. Now that is the reason we debit the goodwill. That is meaning that we have realized in something, but we credit when writing off, meaning that goodwill is no more. It have been shared among the partners. So we credit goodwill at 25,000, but now the remaining partners, we credit their capital account using their new agreed profit sharing ratio. And as you can see, They are agreeing to share the profit in their what? Their already existing profit sharing ratio. That is what the statement was meaning. That is 7:3. P is to R accordingly. So you realize P will have 7/10 times 25,000. That is 17. I think 17. I think maybe do that is 7 divided by 10 times 25,000. That is 17,500. On a R, that is 3/10. For those who can't see clearly, is 3/10 times 25,000, and you realize it is 7,500. 17,500 plus 7,500 should total to 25,000 of the goodwill that, when writing off the goodwill that was credited. So this should show not even a single coin that should exist. No, that is the entries. Now, since we have done the entries, or as the question and asked us to show the journal entries, that is the journal entries that are performed. Now, let's go to the second question, that is extracting the partner's capital account upon retirement of Q. I think now this is becoming his issue with us. Since we, on the credit side of the capital account, we will start by the balance brought down. This is the initial balances they had. From the question, you realize the capital account, the 50,000, that 1,000 and 20,000. I don't want us to mistake. So you start with the balance brought down of P is 50,000, of Q is that 1,000, and R is 20,000. About the goodwill, we record the amount that have been shared and not the amount that have been written off. Note clearly. This is the amount that have been shared when the retiring partner is included. And this is 12,500 as we have done here. 12,500, 7,500 and 5,000. This is the amount that we'll be recording here. That is 12,500, 7,500 and 5,000. But now we have another issue of the fresh capital. About the working, we have this is the working of the total amount that was 100,000. This is the what was done on revaluation, on what was done. No, before we come here, let's now have these balances: 50,000, that 1,000, and 20,000. And we have the goodwill with us. What else do we, or what else are we not having? When you come to the other side of the debit side, you realize we had written off this goodwill. And it was as we calculated, we wrote off the goodwill by doing what? Debiting the remaining partners, that is P and R account, with 17,500 and 7,500 respectively. Now remember, since Q is retiring, or is going out, or is opting out of the partnership, there is this amount, that is 30,000, that he had given out as the capital, and the goodwill that have been realized when he was still in business. These are total amount of 37,000. This was the bank account payable to Q. So Q required to be given that 7,000 so as he can confirm his exit from the partnership. But now what do? We want an amount of we want to increase an amount to 100,000. Which protocol, which procedure will we use? We'll just do, as we can see here, that the ratio was 7:3. So out of that 700 or 100,000, R was to contribute, no, P was to contribute 7 out of 10 times 100,000, that is 70,000. And R should have contributed 30,000. So what you do, you simply carry down this amount that they should contribute. You carry down this amount, you balance, carry down 70,000 and to P and 30,000 to her. Now from carrying down, you had 17,500 plus 70,000. It gives you 87,500. This should be our balancing figure. But on our credit side, we have only 50,000 plus 12,500. It's like we have 62,000. We have 50,000. We have 62,500. That is 50,000 plus 12,500. 62,500. But remember now, our balancing figure, whereas P is concerned, is 87,500. So we subtract 62,500 from 87,500, and you realize we'll have 25,000 as the fresh capital that should be introduced into the partnership by P so as to meet their agreement to have their total capital being 100,000. What about her? You realize that we carried down an amount of 30,000 on the debit side and ends 75,000, which was 7,500, which was the goodwill, which was the amount written off from the goodwill. When you hand with 30,000, you realize it is that 7,500. Yet on the credit side, her have only 20,000 and 5,000. That is 25,000. Then to know the amount that her should eject or should contribute so as he or she can meet the agreement is that 7,500 minus that 7,500 minus 25,000. I think if my calculator is not wrong, the amount that her should contribute the fresh capital is 12,500, and the balancing figure of P on both sides should be 87,500, and that of R should be that 7,500. So, my beloved friends, we have been following on how we treat the accounting entries on partnership, on the issue where we have the retiring partner. And remember, what we have done is when we are just talking about the valuing the goodwill or that reputation of a business. Much welcome to the next class, which will be talking about the second method, that is the valuation of asset and liabilities. That is the method that maybe asset and liabilities might have maybe have appreciated or depreciated, and the retiring partner want to share. How do we account for them? Much welcome. Follow the next class. Had I just humbly requesting you to subscribe, share, and comment, and maybe just be asking any question that I think will be helping each other. Thank you very much. Meet next class.